So in our last module, we are going to start talking about making some adjustments, and you're following on page 532 of your textbook. Unfortunately, this video is going to take us a little while to get through, and there's a lot of information. I'm probably just going to go through and read through the textbook with you, go through the examples, and then you'll have to go back and use that as a reference when you're doing some of the assignments. We did talk about adjusting entries when we were in grade 10 accounting. We talked about the main ones that we did were prepaid expenses such as supplies, insurance, and prepaid rent and depreciation expense. Merchandising companies, it has those and a few more. One adjustment is called bad debts, which are uncollectible amounts owed to the company by its customers. Other adjustments at the end of the accounting period are to record amounts that have not yet been recorded. So almost all companies and many consumers buy on credit at some time. They buy when they need or desire goods or services, and they pay when they have cash or according to the terms of the sale. Our economy relies heavily on credit. More credit sales are made than cash sales. In many product areas, a business cannot survive if it does not offer customers the opportunity to buy now and pay later. Unfortunately, however, sometimes customers do not pay, and this can mean accounting problems for a company that makes credit sales. Accounting problems arise when customers do not pay their debts, and the resulting loss of revenue becomes a bad debt expense for the company. Let us take as an example 2 consecutive years in the business affairs of A. Rapallo Enterprises. We will consider the year 24 to be year 1 and the year 25 to be year 2. Suppose that in 24, A. Rapallo Enterprises makes sales worth $320,000 and the net income of $57,575. If in the next year, 25, customers default on the 24 sales worth $2,000, the 24 net income of $57,575 will be incorrect because not everything was collected. An expense of $2,000 from the bad debts expense account has been included in the expense section of A. Rapallo Enterprises income statement for 24. This results in an adjustment to net income, which is more accurate than the $57,575. The inclusion of the $2,000 expense for bad debts is based on an important accounting standard called the matching principle. It states that expenses for an accounting period should be matched with the revenue produced during the same accounting period. If the $2,000 bad debts expense was not included, the proper total for expenses would not be matched against the revenue for that same period. Okay, so we have our income statement here, and you'll see that there's the bad debts listed there. It shows the accounts receivable figure of $53,000 includes the $2,000 in credit sales that will never be paid by customers. When the balance sheet was prepared at the end of 24, the business hoped to collect all $53,000 of the accounts receivable. However, during 25, the company found that $2,000 worth of the accounts receivable were uncollectible. The $53,000 amount shown in the accounts receivable account is therefore not correct. A figure of $51,000 more correctly describes the value of the accounts receivable, as you can see right here. So we need to make an adjustment. The bad debts expense goes up by $2,000 with a debit, and allowance for doubtful accounts will be credited $2,000. And the effects of this entry is shown here in the T account form. So accounts receivable, as it was on the balance sheet, was $53,000. We have an expense of $2,000 for bad debts. So the allowance for doubtful accounts is $2,000. Bad debts expense appears on the income statement. At the end of the fiscal period, bad debts expense is closed into the income summary account. That's important. We'll talk a little bit more about that in our next video. During the fiscal period, there is no balance in bad debts expense. It is opened with the adjustment made at the end of the fiscal period. It is then reduced to a zero balance when the closing entries are prepared. So that's only used at the end of the month or at the end of the year. The partial balance sheet contains the accounts receivable control account with a balance of 53,000. A. Rapallo Enterprises estimates that 2,000 worth of the accounts receivable balance will become bad debts. Why is this asset receivable not recorded 2,000 when the adjustment is made? This is not done because it is not known which customer will be uncollectible. Therefore, it is not possible to credit any customer's account in the accounts receivable ledger. Furthermore, it is not possible to credit the accounts receivable control account in the general ledger because the control account must always equal the total of the individual customer's accounts in the accounts receivable ledger. That is why we need the allowance for doubtful accounts. Allowance for doubtful accounts appears in the assets section of the balance sheet, but is considered to be a contra account for a valuation account. As explained earlier in the text, a contra account reduces the value of the account that it describes. The allowance for doubtful accounts is to use to determine a realistic valuation for the accounts receivable control account. The accounts used to record an accumulated depreciation on various assets are also valuation. So I'll just bring that up there so you can see it a bit better. You see the accounts receivable, and then you see that the subtraction of the doubtful accounts to be the total to be 51,000. There's two methods commonly used to determine or to estimate the bad debts expense are the balance sheet method and the income statement method. Whichever method is used must be consistently followed because we have a principle that tells us we need to keep consistent with the methods that we're using. The income statement method of estimating bad debts uses a percentage of net sales. It is based on the question, how much of this year's sales will become bad debts? This is how it works. The accountant examines the bad debts losses in previous years and uses that to forecast the loss for a given year. If, for instance, the losses have consistently been about 1% of net sales, then 1% is used for the adjustment. If sales are 320,000 and the sales returns are 10,000, the net sales is 310,000. Since 1% of 310,000 is 3,100, this is the amount used for the adjustment entry, and there's the entry made there. However, this does not eliminate the need for the accountant to review the accounts receivable to determine if there's any significantly overdue accounts that should be considered when making the estimate for bad debts. There could be more, so they have to kind of double check that. The second one is called the balance sheet method. Many companies examine their customers' accounts to estimate the uncollectible balances. This is known as the balance sheet method because it uses asset accounts receivable as a basis for estimating bad debts. To determine the valuation of the uncollectible accounts, an accounts receivable age analysis is prepared. This is a list that shows the balance owed by each customer, and it shows how long the balance has been overdue. So the customers are listed here, and then here it lists how long. So of course the ones that are 90 days and over are ones that you're thinking you might not be getting back. The age analysis tells a manager which customers' balances have not been paid for various time periods. The manager can then decide when to stop giving credit to a customer or when to start collecting proceedings against a customer. At the end of a fiscal period, the age analysis is used to determine the amount required for a bad debts expense adjustment. For each age group, the accountant estimates a percentage loss. For example, past experience might indicate that 50% of all debts over 90 days past due will be uncollectible. So this shows us how we would figure that out. Therefore, $950, which is 50% of the 1900 that was 90 days and over, will probably be uncollectible. In a similar way, estimates are made for each of the age groups, showing the percentages considered uncollectible. So if it's current, see how these numbers go down? They go up as the time increases. The longer somebody owes you money, the less chance that you're going to be seeing it. So here, if you want to just go through that, it tells you the 3 steps that you need to do. Basically, you have to prepare an accounts receivable age analysis by the customers and how long they owe you the money. You need to estimate a percentage loss, and then you need to prepare an adjusting entry. When you use the balance sheet method to estimate bad debts, you must consider an existing balance in allowance for doubtful accounts when preparing the adjusting entry. For example, suppose that the balance in allowance for doubtful accounts was set at $1,500 the previous year, but only $1,450 of receivables had to be written off. That would leave a credit balance of $50 in this account. This year's the age analysis indicates an estimation for bad debts to be 2,000. A credit of 1950 is required to bring the balance for allowance for doubtful accounts to 2,000. Okay, so you see how they've come up with that there. They had a credit balance of previous balance of 550. They need to have an adjustment to 1950 to bring it back up to 2,000. The result of the adjusting entry in T account form would appear as follows. You have your bad debts, 1950, as it appears on the income statement. You have your balance credit of 50, your 1950. Your new balance here would be 2,000. Where does the $50 beginning balance and allowance for doubtful accounts originate? It could be caused by the collection of an account previously written off or by the overestimation of bad debts from the last accounting period. Remember, the adjustments for bad debts is an estimate only. It is usually impossible to estimate the exact amount of the bad debts. There will generally be a credit balance in allowance for doubtful accounts. When you use the balance sheet method to adjust for bad debts, the previous balance must be considered. With the income statement method, it is just ignored. The reason for this is that the income statement method identifies new bad debts based on new credit sales, whereas the balance sheet method estimates cumulative bad debts based on all accounts receivable. It is possible to have a temporary debit balance in allowance for doubtful accounts. This occurs when the actual amount of bad debts for the period exceeds the estimate. Suppose the age analysis indicates an estimate of 2,000 for bad debts and there is an existing debit balance of 100. In this case, an adjustment of 2,100 is necessary. Writing off uncollectible accounts. Three accounts are involved in the adjustment for bad debts. They are accounts receivable, that's important, allowance for doubtful accounts, and bad debt expense. The first two accounts appear in the assets section on the balance sheet. The third, bad debts expense, appears on the income statement. It is closed at the end of the fiscal period. At the beginning of the new fiscal period, there are three accounts will appear in the T accounts, and they'll look like this. What does a company do when it determines that it will never be able to collect a debt owed by a customer? The following system is used by A. Rapallo Enterprises. Suppose that by March 12th, it is clear that $750 owed by J. Wilson will never be collected. So when that is decided, they're going to debit the allowance for doubtful accounts, and they're going to go ahead and credit the receivable for J. Wilson because they know that that person is not going to be paying. The 750 credit is posted twice, once to the accounts receivable control account in the general ledger and also to J. Wilson's account in the accounts receivable subsidiary ledger. Notice that this entry, the bad debts expense account, is not used. The loss is written off against allowance for doubtful accounts. Remember that a total of 2,000 was recorded in bad debts expense when the adjustment was made. To record 750 loss in bad debts expense would be wrong because the expense would be recorded twice, once in the adjustment and once in the write-off. After J. Wilson's account is written off, the T account would appear as follows. A credit to accounts receivable, a debit to allowance for doubtful expense, and a credit to the J. Wilson, and you notice that the account is now closed and we didn't do anything to the bad debts expense. During the year, write-off entries are made whenever it is certain that a debt is uncollectible. At the end of the year, there will probably be a balance in allowance for doubtful accounts because it's almost impossible to correctly estimate a year's uncollectible accounts. When the next fiscal period ends, the balance in allowance for doubtful accounts must be considered if the balance sheet method of adjusting for bad debts is used. The income statement method ignores any such balance. Okay, we're getting really close to being done. Payment of an account receivable previously written off. Sometimes an account that was assumed to be uncollectible and written off is unexpectedly collected. Such payments are termed recovery of bad debts. When this occurs, it is necessary to make two entries. In the previous example, J. Wilson's account was written off. On June 1st, Wilson unexpectedly pays A. Rapallo Enterprises the full amount, two entries are made. The first one records the debt in the customer's account again and reestablishes the amount in the doubtful account. So that is that one. The second entry records the money received and decreases the customer's account. Looks like that. Okay, we also need to talk about accrued expenses. Adjusting entries are required for any expenses that are owed but not yet recorded. These are called accrued expenses. They've been incurred but not journalized and posted to the general ledger. Interest owed but not recorded is an example. So suppose A. Rapallo Enterprises borrows $10,000 from a bank in October 1st and will repay it within interest in 6 months. On March 31st, interest of 9% is charged by the bank. The following entry is made when the money is borrowed. So that's borrowed. On December 31st, the end of the fiscal period, the bank is owed 3 months of interest. This amount is an expense and should be on the income statement. The interest for 3 months is $225. That was found by taking the 10,000, timesing it by the 9%, and they're paying 3 of the 12 months for $225. This amount must be shown in the interest expense, $225, and in the interest payable, $225. After this entry has been posted, the interest expense, bank loan, and interest payable accounts appears as follows. So we have interest expense, our bank loan stays the same, and our interest payment has been increased, payable has been increased. We also have accrued salaries. A second example of an unrecorded accrued expense is salaries earned but not yet paid. The most common reason for accrued salaries is that the financial period end does not match an actual payday. Another reason for accrued salaries comes in companies that pay a sales commission as part of all of the employees' entire compensation. This type of compensation is fairly common in retail sales. A. Rapallo Enterprises pays its sales staff a commission of 10% of their monthly sales. This commission is calculated and paid in the following month, the previous month's salary. For example, in December, the sales staff made sales of $12,000. The commission, 10% of $12,000 is $1,200, is paid at the end of January. However, since it was earned in December, the amount of commission should be part of the financial statements prepared in December. So they need to have an adjustment. We have a salaries expense of $1,200, and we have salaries we need to pay of $1,200. When this entry is posted, the accounts appear as follows. We also have accrued revenue. If the revenue section of the income statement is to be correct, it must contain all the revenue that has been earned. This is a requirement of the revenue recognition principle. Accrued revenue is revenue that has been earned but not journalized and posted to the general ledger. A. Rapallo Enterprises purchased a 3-year guaranteed investment certificate of $10,000 from its bank. The certificate earns 9% interest or $900 per year. The interest, a total of $2,700, will be received at the end of 3 years. However, $900 in interest is actually earned each year, so it's split up this way. Since $900 interest is earned at the end of year 1, that interest should be recorded as revenue and included on the income statement for year 1. If it were not recorded, there would be a mismatch between the revenue and expenses. Some of the revenue for the year 900 would not be matched against the expense for the year. To avoid this error, we need to make an adjustment. Our interest receivable goes up by $900 and our interest revenue goes up by $900. Okay, we also have unearned revenue. Accrued revenue is revenue earned but not yet recorded. Another form of accrual is unearned revenue, which is revenue that has been received but not yet earned. Unearned revenue is illustrated. New York Software supplies technology support services to customers. It is preparing its financial statements on December 31st. On October 1st, one New Star Software customers paid $6,000 for support services for 6 months, $1,000 for each month. This entry was made in October. Okay, so we have our cash going up and we have to put it into unearned revenue because it's revenue in the future. Unearned revenue is a current liability. New Star Software owes the customer $6,000 worth of work, or it must return the $6,000. The $6,000 is a liability until the service is provided. When the work is provided, the prepayments will be recorded as revenue. On December 31st, the support services have been provided for 3 months. The value of the work 3,000 should be recorded as revenue, and the liability account unearned revenue should be reduced. So now here you're actually receiving the 3,000, and now you can debit the unearned revenue account here. When the December 31st financial statements are prepared, they will reflect a proper matching of revenue with expenses. The 3,000 reflecting the work completed will appear in the services revenue account on the income statement and will increase overall revenue. The remaining 3,000 of work still to be provided will remain as a current liability on the balance sheet in the unearned revenue account. Also on the balance sheet, the original 6,000 that was received as a prepayment will be included as part of the cash account balance. So there's our summary of our accrued adjustments. Adjusting entries are necessary for accrued revenue, unearned revenue, and accrued expenses. So we need to remember those. If the accrued expenses are not recorded, there will be a mismatch, and this is what happens when they're mismatched. If accrued revenue is not recorded, then this is what happens. And if unearned revenue is not recorded, then this is what happens. So you can go back and have a look at those. There's a lot of information here. Go through the examples and the questions that I give you that and the answer keys, and I'm here if you need any help.